Civilizations are built on more than walls, monuments, and armies. Beneath the grandeur of temples, palaces, and bustling marketplaces lies an invisible force, one that shaped human history as profoundly as kings and empires ever could. Numbers, ledgers, contracts. These were the silent architects of civilization. When we think of banks today, we imagine sleek buildings, digital transactions, and complex financial systems that span continents. But humanity's first bank was not a skyscraper filled with computers nor a vault brimming with gold. It was something far simpler, yet far more revolutionary. A system rooted in trust, records, and the management of resources. The first bank in the world did not appear in a bustling European city or a modern financial hub. It emerged thousands of years ago in the cradle of civilization, Mesopotamia, the land between the Tigris and Euphrates rivers. Here, in the shadows of ziggurats and under the watchful eyes of gods, the foundations of banking were laid. Clay tablets, grain, silver, and labor were the currency of a new order. This is not just a story of finance. It is the story of power, trust, and human ingenuity. How did the first bank function? Who controlled it? And how did it quietly shape the course of history in ways we still feel today? Section 2. Mesopotamia and the origins of banking. Thousands of years before modern banks, before coins, before paper money, there were temples. In Mesopotamia, temples were more than sacred spaces. They were the heart of the economy, the first financial institutions the world had ever known. Farmers, artisans, and traders all depended on them. Temples owned vast tracts of land. They collected taxes, stored grain, and lent resources to those in need. A farmer who faced a poor harvest could borrow seed, grain, or livestock from the temple to plant the next season. And when harvests were abundant, the farmer repaid the loan, often with interest. These loans were not casual agreements written on scraps of paper. Every transaction was recorded meticulously on clay tablets, etched with cuneiform symbols using a reed stylus. These tablets were the earliest ledgers, the ancestors of our modern balance sheets, capturing debts, repayments, and even the identities of borrowers. Some tablets bore seals of witnesses, early forms of authentication, ensuring that contracts could be enforced. Interest existed even then. Around 3000 BCE, a common rate might be 1/3 of the loan, paid in grain or silver. Borrow 100 bushels, repay 133. This was more than a financial transaction. It was a tool of social control. Debt tied individuals to the temple system, ensuring that production continued even during difficult times. The temples did not just lend, they managed risk, stabilized food supplies, and maintained social hierarchy. They were early central banks, balancing the needs of farmers, merchants, and the state itself. And with every clay tablet they recorded, they created a system built on trust, transparency, and accountability, the same pillars that underpin banking today. Yet this system was fragile. Failed harvests could trigger debt spirals. Families who could not repay loans risked losing land, livestock, or even freedom. Mesopotamian kings occasionally issued debt forgiveness decrees, erasing obligations to stabilize the economy. In doing so, they understood a truth that modern bankers still recognize. When too many people are trapped in debt, the system itself teeters on the edge of collapse. Trade thrived alongside banking. Caravans crisscrossed deserts and rivers, carrying grain, textiles, metals, and luxury goods. Merchants relied on contracts and seals to secure transactions over vast distances.
The combination of banking, record-keeping, and trade created a network that resembles the modern financial system more closely than one might expect. In Mesopotamia, the first bank was not a building of stone. It was a temple, a ledger, and a network of human trust. It was a system designed to keep the wheels of civilization turning, even in the face of uncertainty, scarcity, and human ambition. Section 3. The mechanics of ancient banking and credit. Mesopotamian banking was not only about storing grain or lending resources. It was a complex web of credit, contracts, and legal oversight. At the heart of the system was a simple yet profound principle. Trust could be quantified and enforced. When a merchant or farmer needed resources, they did not simply receive them freely. The temple recorded the transaction, specifying what was borrowed, the repayment terms, and any interest due. These contracts were binding. Clay tablets were archived, and the scribes, trained experts in record-keeping, monitored each account with precision. These scribes were the accountants, auditors, and regulators of their time, ensuring that the flow of goods and credit remained orderly. Interest, or the price of borrowing, was not arbitrary. It was standardized, predictable, and enforced by law and tradition. Loans encouraged productivity, but they also tied borrowers into a system they could not easily escape. Debt was both an incentive and a mechanism of control. Yet, Mesopotamian banking was remarkably forward-thinking. Temples did not simply lend and collect, they balanced risk. If a region suffered a drought, scribes adjusted records, sometimes forgiving loans to prevent collapse. In other cases, surplus harvests were strategically distributed to stabilize food supplies, maintain social order, and secure loyalty to the temple system. This early banking system also connected trade networks across vast distances. Merchants could rely on the temple's credit system to finance caravans, ensuring goods flowed between cities and regions. Contracts and seals created trust even between strangers, forming a proto-global economy long before the concept of international trade existed. The brilliance of Mesopotamian banking lay not in buildings or coinage, but in its understanding of human behavior. Trust, obligation, and accountability were currency as real as grain or silver. By recording these relationships, the temples transformed abstract concepts of debt and value into enforceable social structures. Through this system, the first banks shaped more than the economy. They shaped society itself. They dictated who had access to resources, who could trade, and who could prosper. They were, in every sense, the invisible engines of civilization, quietly orchestrating the rhythm of life in Mesopotamia, one clay tablet at a time. Section 4. The spread of banking concepts across ancient civilizations. While Mesopotamia gave birth to the first banks, the concept of organized credit and resource management did not remain confined to one civilization. Across rivers, deserts, and mountains, other ancient societies began experimenting with their own versions of banking, each shaped by local culture, geography, and needs. In ancient Egypt, the economy revolved around the Nile and the pharaoh. Here, temples were also economic hubs, but the state held far more centralized control. Grain, the bloodlife of Egyptian society, was collected, stored, and redistributed by the bureaucracy. Workers on monumental projects like the pyramids were paid not in coins, but in rations of grain, beer, and oil. These rations functioned as currency, tying labor to the state's stability. Egyptian banking was less about private loans and more about ensuring that the machinery of civilization ran smoothly. Taxes, payments, and resource allocation were meticulously recorded on papyrus scrolls, revealing a system designed to balance abundance and scarcity with divine order. Pharaohs acted as ultimate bankers, controlling wealth, labor, and production in the name of maintaining mayat, balance and harmony. Farther east, the Indus Valley civilization demonstrated a different approach. Lacking grand temples or powerful kings, the Indus people relied on precision, standardization, and trade networks. Archaeologists have uncovered uniform weights, measures, and standardized bricks across hundreds of cities. These tools ensured fairness in trade, effectively functioning as a shared economic code.
The Indus system emphasized cooperation and mutual trust over central authority. Merchants exchanged cotton, beads, and spices for metals and luxury goods. Contracts may have been unwritten, yet consistency in standards enabled trade to flourish. Their economy thrived on silent enforcement, the implicit understanding that fairness and reliability were paramount. Meanwhile, in ancient China, the seeds of state-controlled banking were also taking root. By 1000 BCE, Chinese rulers issued bronze coins and carefully monitored their circulation. During the later dynasties, the Chinese developed a highly centralized approach to currency, eventually introducing paper money centuries before Europe. This innovation allowed trade to expand across vast distances, demonstrating a sophisticated understanding that money could exist not as a physical object, but as a promise backed by trust in the state. Across these civilizations, a common theme emerges. Banking and finance are not merely about money, they are about trust, organization, and social control. Whether through temples, bureaucracies, standardized measures, or state-issued currency, ancient societies discovered that controlling the flow of resources and the rules of exchange was the key to stability, prosperity, and power. The first banks were not the banks we know today. They were human institutions designed to manage scarcity, enforce obligations, and preserve order. Yet, despite differences in culture and technology, their core principles, trust, accountability, and the regulation of resources remained foundational to every financial system that followed. Section 5. Rome and the legalization of banking. As centuries passed, the principles of Mesopotamian and Egyptian banking evolved, finding new expression in the city-states and empires of the Mediterranean. Rome in particular transformed banking from a temple-based or state-controlled system into something remarkably modern, legalized, structured, and integral to the expansion of an empire. Roman banks, known as argentarii, were private enterprises. They accepted deposits, extended loans, exchanged currency, and even facilitated trade across the Mediterranean. Contracts and written agreements, often witnessed and sealed, guaranteed that obligations were enforceable. Rome codified financial rules into law, creating a legal framework for banking that protected creditors, borrowers, and merchants alike. Coinage played a central role. Roman coins, stamped with the emperor's image, circulated widely. They were more than money, they were instruments of authority, a daily reminder of who controlled wealth and power. Every transaction reinforced the social order, intertwining economics with governance and propaganda. Interest and lending were sophisticated. Loans were made to individuals, merchants, and even provinces, often tied to collateral. Borrowers risked land, property, or future income, and contracts specified the terms in detail. Debt, in Rome, was both a financial tool and a social instrument, linking citizens to a system that reinforced hierarchy and accountability. Rome's banking system supported its vast empire. Trade routes, roads, and ports were backed by financial mechanisms that enabled merchants to move goods efficiently. Olive oil, wine, grain, and luxury items flowed along these arteries, financed by loans and credit systems rooted in trust and enforceable law. In essence, Rome created the first truly integrated economic network across continents, a precursor to global finance. Yet, Rome's financial brilliance carried inherent fragility. Concentrated wealth, unchecked debt,
and political corruption occasionally destabilized the system. Inflation, defaults, and economic crises mirrored the same patterns observed in Mesopotamia and Egypt, proving that banking, no matter how advanced, has always walked the delicate line between stability and collapse. By legalizing banking, Rome cemented the idea that finance could be formalized, regulated, and made central to state power. Laws governing contracts, loans, and interest laid the groundwork for centuries of European banking that would follow. The Roman Empire, in many ways, became a laboratory for understanding how money, law, and human behavior intersect to build or crumble civilization.
Section 6. China and the revolutionary invention of paper money. While Rome was legalizing banking in the Mediterranean, another transformation was unfolding in the East. China, with its vast population and sprawling trade networks, confronted the same challenge every civilization faces: how to manage resources efficiently, maintain trust, and enable commerce across great distances. By the Tang Dynasty, 7th to 10th century CE, merchants and governments were already experimenting with promissory notes, paper instruments representing value, backed by the credibility of the issuer. These were early forms of checks, a way to conduct large transactions without moving heavy coins. It was during the Song Dynasty, 11th century CE, that China fully revolutionized money. The government began issuing state-backed paper currency, accepted across cities and provinces. This was banking reimagined. Value existed not as metal, but as trust, guaranteed by the authority of the state. Merchants, traders, and farmers relied on this system, fueling unprecedented economic growth, trade along the Silk Road, and the rise of urban centers. China's innovation illustrates a profound truth. Money is not gold or silver. It is a social agreement. Paper money worked because people believed in it, because they trusted that the state would honor its promise. Trust, accountability, and verification, the same pillars that supported Mesopotamian temples and Roman Argentari, were central once again. Across Mesopotamia, Egypt, the Indus Valley, Rome, and China, a pattern emerges. The first banks were never about architecture, technology, or profit alone. They were about creating systems that enabled civilizations to store value, exchange it, and grow without collapse. Trust and record-keeping, legal enforcement, and social order, these were the invisible structures that allowed societies to flourish. And from those first clay tablets to Roman law codes, from papyrus scrolls to paper money, the DNA of modern banking was already written. Today, when we swipe a card, transfer funds online, or invest through digital platforms, we are participating in a tradition that stretches back over 5,000 years. Humanity's first banks were not merely financial institutions. They were the backbone of civilization itself.